High yield loans, also known as bank loans or leverage loans, are a great asset class that I think play a role in most investors' portfolios, especially if you are running a balanced strategy. In this presentation, we're going to talk about what kind of returns you can expect from leverage loans and what risks you want to be aware of before investing in this asset class. Let's quickly talk about what leverage loans are. Leverage loans are bank loans, generally with a 5 to 7 year term, that are made to mid-cap size companies. These loans pay quarterly interest. The interest rate is based off of SOFR with a static spread on top of SOFR that is negotiated at the beginning of the loan. These loans are made to non-investment grade companies. Usually, when you look at a loan fund, you're going to find that the average credit rating is in the B category, below investment grade. Leveraged loans have a small amount of principal amortization over the term of the loan. Generally, about 1% of outstanding principal is repaid per year. It's pretty minimal. When the loan matures, the borrower will either pay off the loan or amend and extend. If the borrower chooses to amend and extend, they will renegotiate the loan terms with the lender. The buyers for leverage loans are institutions, mutual funds, ETFs, asset managers, banks, hedge funds, pensions, etc. Let's talk about returns. We're looking at an illustration over the last 5 years for a common floating rate loan fund, leverage loan fund, the Fidelity Advisor Floating Rate High Income Fund, Z shares. We're looking at total return for a $100,000 investment made 5 years ago, and we're comparing the total return for this loan fund against the Bloomberg U.S. Aggregate Bond Index. Notice that in the last 5 years, the Bloomberg U.S. Aggregate Bond Index has a negative total return, while bank loans have produced a positive total return. In this case, a $100,000 investment in Fidelity's FIQSX is now $138,000 with total return dividends reinvested versus the Bloomberg US Ag, which has not made any money in the last 5 years. Over the last 10 years, Fidelity's floating rate high income fund is about 36% ahead of the U.S. Aggregate Bond Index. And over the last 25 years, since the inception of the Fidelity Floating Rate High Income Fund, the fund is ahead of the U.S. Aggregate Bond Index. It's about 13% cumulative, with much of that outperformance happening in the last few years. There's a lot that we can learn by studying this chart, comparing the Fidelity Floating Rate Loan Fund over the last 25 plus years to the U.S. Aggregate Bond Index. Number one, leverage loans have very limited duration. So when interest rates rise, your principal isn't going to go down substantially like the bond index did starting in 2022. You see the big drop here. That was due to rising interest rates. Falling interest rates are not going to give your position in loans a big push up like they do to fixed coupon bonds. So the U.S. Aggregate Bond Index had a tailwind during the early 2000s. As interest rates were going down, you see a lot of performance here from the U.S. Aggregate Bond Index, which is mostly fixed coupon bonds. When a recession occurs, bank loans are generally going to take a hit, and fixed coupon bonds may not. If you look at what happened in 2008, you see a pretty quick drawdown in leverage loans. Then again in 2020. Now we recovered in just a couple years, but this is one of the risks that you want to be aware of with bank loans or leverage loans. When we have a recession, spreads generally widen. We're going to talk about spreads in a little bit more detail here in a minute. But when spreads widen during a recession, pricing for loans generally falls. When we come out of the recession, the pricing usually comes back and the loans typically recover. Here's some drawdown information for the U.S. Aggregate Bond Index versus leverage loans using the Fidelity loan fund as a proxy over the last 10 years, we can see that the 10-year max drawdown for the Fidelity Advisor floating rate high income fund was 22.11, but the U.S. aggregate bond index was pretty close to it, 18.41. They went down for different reasons. The big drop of 22% for leverage loans in 2020 was primarily due to default risk, credit risk, spread risk, liquidity risk. Those risks combined caused a fast drawdown, and then fortunately we got a quick recovery. Interest rate risk is what took down the U.S. aggregate bond index over 18% in 2022. As interest rates were going up, bonds were getting crushed. But notice that we didn't have much drawdown with loans, and that is because there is no duration risk, or very limited duration risk rather, with leveraged loans. Spreads over treasuries play a significant role in leveraged loan pricing. When spreads contract, leveraged loan prices will go up, and when spreads widen, leveraged loan prices are going to go down. We're looking at the U.S. high yield B option adjusted spread back to 1996. I want to focus on 2008 and 2020. You can see spreads rising or widening in 2008. The gray bands are recessions on this chart. And when those spreads widened out to over 18% for leveraged loans, that is when we saw the price drop in leveraged loan funds. Happened again in 2020. Notice that we see spreads for a very brief time period are widening out substantially, almost 12% in 2020. And then they tighten back up. So when the spreads widened, bank loans contracted in price. When the spreads came back in, the prices went back up. Simple way to think about leveraged loan pricing and the relationship with spreads is it's an inverse relationship. When spreads widen, prices are going down. When spreads contract, prices are going up. Most loan funds, like Franklin's Senior Loan ETF FLBL or Fidelity's High Income Fund FIQSX, are going to have an average credit score of B. I wanted to show you where that falls on Moody's scale for long-term global bond ratings. We're starting at AAA, that's the highest quality. Notice that B is non-investment grade, aka junk, highly speculative, subject to very high credit risk. In addition to credit risk and spread risk, you also have default risk and liquidity risk with leveraged loans. Funds that manage leveraged loans can trade them. There is a marketplace for leveraged loans, but it's not as robust as traditional bonds like treasuries or investment grade corporate bonds, for example. When leveraged loans need to be traded, the manager selling the loan is probably going to take a pretty significant discount, a concession, if you will, to sell that loan. During periods of market stress, like the recession of 2008 or the spring of 2020, the liquidity risk really becomes a factor. If your fund manager needs to sell a number of loans, they're going to take a big haircut, and that will impact your performance. The long-term average default rate for leveraged loans is about 3%. In good economic times, that default rate can dip down below 2%. It can get as low as 1.5, 1.7. In bad economic times like 2008, the default rate spikes and it can get as high as 10%, maybe higher. In 2008, we saw 10% default rate for leveraged loans, but the long-term average is about 3. The recovery rate for leveraged loans is about 65 to 70%. So if you have a loan for $100,000, you may only get back $65,000 or $70,000 during a bankruptcy proceeding. Now that rate can vary too. It depends on what type of assets your company has, how indebted the company is, et cetera, and what industry the business is in. Are you a service business? Are you an industrial business? What's the nature of the business and the assets and the resale value? But in general, you're looking at 65 to 70 cents in the dollar for a recovery rate on defaulted loans. Despite all these risks, there are 3 reasons that I really like leveraged loans as an asset class in a portfolio. Number 1, loans are at the top of the credit stack. If there is a bankruptcy, loan holders get paid before bondholders. So compare high yield junk bonds to leveraged loans. They're in the same credit space. But the recovery rate is going to be higher for loans than it is for bonds, and that matters. Number 2, yield premium. Leveraged loans pay significant yield premium over comparable term treasuries. All that extra interest really adds up over time. And number 3, low duration. Leveraged loans have very low interest rate risk. So if we get another 2022 environment where interest rates start going back up and traditional fixed income starts dropping from interest rate risk, you won't have nearly as much interest rate risk on floating rate leveraged loans. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.